All right, so we're recording now. This is the second open lab for the final exam in healthcare finance. So first I'm going to go over what you guys can expect from this test, and then we will have time for any questions that you may have. So first of all, the test is timed as the first two have been, but it's a little bit longer time limit. You'll have 2 hours and 20 minutes to take this final exam. So make sure you plan accordingly and sit down in a quiet place where you can focus for a while. There's going to be 73 questions total on the test, which is a bit more than what we've seen on previous tests. 28 of those questions are multiple choice and true false. One of them is a matching question, the terms for which you'll find in chapter 11. Most of them are found in the margins on the side of the page, but it's the terms like debenture and trustee and those kinds of terms that we read about when we were learning about bonds and investments. The next section is short answer and fill in the blank. There's 28 of those questions. Those are very similar to what we've seen on the previous two tests. And then there will be 15 problem questions. So I've written down what kinds of problems and documents and things you'll need to be able to go over. So I'll go through those. First of all, just to go back to the multiple choice and the short answers, a lot of these questions are taken directly from the previous two exams. And they'll be focusing on things that we've covered the whole semester. So make sure you refresh your memory about things like not-for-profit versus for-profit, and what are the benefits of those, and cost allocation and the different methods for that. Make sure you review some of those things before you come to this exam. Fixed costs, variable costs, what those are, and different things like that. But again, a lot of that comes directly from the previous two tests that we've taken. So review your assignments, especially your chapter, end of chapter question assignments, and those are like perfect study guides for you to prepare for these tests. So the problems, as I said, there are 15 problems. They're split up, and I'll go over the main topics that you need to understand for these problems, though there may be a couple questions for each one. The first one is, again, you need to know how to set up an income statement. And so, again, that's on page 85. It's in chapter 3 of the textbook. Once again, it's page 85. There's a good example of an income statement there. One thing I want you guys to note is that the bad debt portion of that, provision for bad debt, in this example, it shows it as an expense, but it is now supposed to be moving to, now it should be moving to being placed under the revenue section. So you'll put your gross patient services revenue, and then you will subtract the provision for bad debt from that and have net patient services revenue. That's where we should find provisions for bad debt. But familiarize yourself again, refresh your memory about which line items go in which sections. Make sure you understand the structure. You do revenues first, then expenses. When you take total revenues minus total expenses, you get your operating income, and then comes your non-operating income section, followed by your bottom line, which is the profit. So just look over that to make sure you remember what goes where. You'll need to be able to determine the cash flow. Do any of you guys remember the equation or the thing that we do to find the cash flow estimate for using an income statement?
Is it let's see. Is it your revenue minus your operating? Let me see. Operating income?
No. So the cash flow shows you a basic idea of how much cash you actually receive. So you're going to take your net income and add back to it any non-cash expenses. So in this class, that's simply depreciation. So depreciation plus net income will give you your cash flow. So the next thing that you'll need to understand, the problem section, is how to set up a balance sheet. And again, that's from the first section that we went over, the first 4 chapters. That's going to be on page 112 of your textbook. There's a good example there of a balance sheet. And one thing to keep in mind is the accounting identity, which, if you remember, is that equation assets equals liabilities plus equity. So as you're making your balance sheet, again, I would recommend that you review which line items go in which sections. There's current assets and long-term assets. There's current liabilities and long-term liabilities. Make sure you know what goes where. And then a good way to check to make sure that your balance sheet is balanced is to use that assets equals like liabilities plus equity. So your total assets should be the exact same amount as your total liability plus the equity. And if it's not the same when you're done, you've put something in the wrong place, or you've simply added things up incorrectly to get those totals. So we'll need to get the net working capital from that and the debt ratio from the balance sheet. So does anyone remember how we find the net working capital?
Current assets minus current liabilities.
Good job, Connor. So current assets minus current liabilities.
Totally redeemed myself there.
Yeah, good job. So current assets minus current liabilities is your net working capital. Basically shows you if you needed to have money on a moment's notice, how much would you have after paying off your current liabilities? The debt ratio then, what is the debt ratio? Does anybody know? Okay.
Your
Oh.
is it your total assets divided by your total liabilities?
That was current.
Or is that one correct?
You got that flipped, Connor. So it's total liabilities divided by total assets.
Oh.
So Andrea, when you're using net working capital, it's current assets minus current liabilities. But with the debt ratio, it's total liabilities minus the total assets of the company.
So net working capital is current assets minus current liabilities.
Yeah.
But then debt ratio is total liabilities divided by total assets.
Divided by total assets. That's
Okay.
right.
Cool.
Okay. Next, you need to understand how to create a profit and loss statement. And that one was one of the easier statements that we learned about. There's a good example on page 176. If you remember, that's the one that shows the total revenues, the total variable costs. You subtract variable costs from revenues to get the total contribution margin. And then you have the total fixed costs, which you subtract from your contribution margin to get your profit or loss. So you need to understand how to set up that statement and also determine the per unit contribution margin. And then if you remember, in that same section, we talked about break-even analysis. So there's economic break-even, and then there's the other term is slipping out of my head right now. Volume break-even, I think, is the volume break-even and economic break-even. So you need to determine what volume do you need in order to have a $0 profit or loss. And we've gone over that before, and if we need to review these things, we can do that in a sec. And then economic break-even is if given a certain profit target that you want to make, what volume do you need to make that profit? And the equation for that, if you remember, is the total revenues minus the total contribution margin minus fixed costs equals profit. And when we're doing volume break even, we set the profit to 0 because our profit is nothing. And then you can solve for the variable that you're trying to find. So along with finding volume, you need to be able to find the necessary price to break even with a given volume. So it will tell you, we're going to sell 4,500 of these services, and this is how much it costs us. What price do we need to set this at in order to have a $0 profit? And what price do we need to have a $100,000 profit, for example? So break even, that's a good one to review. And then we talked about time value of money a little bit, so understand how to solve for future value, present value. And then finally, there's a few problems on these last few chapters that we went over with bonds. This last chapter, I guess, chapter 11. I know it was a few weeks ago. So the first one is you need to be able to determine the required rates of return on a stock if you're given the beta. And we can go over that. But the equation for that is the required rate of return, which is what you'll be trying to solve for, equals the risk-free rate plus, and then in parentheses, the market rate minus the risk-free rate, close parentheses, and times beta. And that'll probably be a problem we'll go over here in just a second. I've never had
Can you
anyone.
say that one more time?
Yeah. So the required rate of return equals the risk-free rate plus, and then you open parentheses, the market rate minus the risk-free rate, close parentheses, times beta.
Thank you.
You're welcome. So you should be given the market rate, the risk-free rate, and the beta, and you just need to then solve. So then you'll need to also understand bond valuations. So for example, it'll tell you the number of periods that are remaining, what the coupon rate is, and then the going rate. And then you'll solve for the present value of the bond if you were to sell the bond to somebody else. And then finally, you'll need to find the rate, so the yield to maturity. How much is this worth? What's the rate percentage? And those are formulas that you can simply plug into Excel. And we can go over those if you guys would like. That's basically everything for the problems. And then again, the questions beforehand are mostly a review of a lot of the stuff we've covered, with a few questions again regarding some of the things that we covered in the last few chapters.
Do you know what the percentage is of how much the problem answers are going to be? Is it like worth 50% of the grade, 60% of the grade?
I don't know total, but the problems do tend to be heavier weighted.
Yeah.
Let me look really fast here and see if I can determine that really quick. While I'm looking that up, does anyone else have a question? No? Okay, give me 1 second. I'll look this up.
Okay,
You can
thanks.
share your screen too if you want to, Tyson. You just share your screen if you want to.
Yeah, that wouldn't go over well. All right. Give me 1 second. I'm doing math in my head. Okay. Sorry guys, there's not a place that I can just look it up. So give me 1 second. Right. No, they're here. I'm just looking something up for you.
Oh.
Okay. Let's see here. So it looks like the problem section will be close to half the grade for the test. And I can maybe figure out an exact number if you'd like me to.
Oh, no, that's okay. Thanks. I was just kind of curious.
Yeah, and I
about
actually think it's
that.
surprising.
And are some of these questions going to be standalone questions, or are they going to kind of follow into others, kind of like a chain reaction, like some of the previous tests?
Yes, like that. So it'll ask you it'll ask you to form an income statement, and then the next one will ask you what is their cash flow.
Okay,
And
got it.
One will ask you what is to make a profit and loss statement, and the next one or two will ask you to do break-even analysis, and then the next one will do price break-even analysis, for example.
Okay, got it. Okay, thanks for letting me know about that.
Yeah, no problem. What other questions do you guys have, or is there something that you'd like to go over?
I'd like to watch you do the bond valuation. I saw you did the required rates of return on your other video. So I kind of want to see the bond valuation again just to make sure.
Okay, yeah. Let me pull this up here. All right, can you guys see that screen there? So the bond valuation, like I said, you can just plug it all into Excel. So it will give you a scenario, like it'll say there are 8 years remaining, and I'll just clear these out really fast, actually. So there are 8 years remaining on a bond. So a bond normally has a 10-year life. Let's say it's got 8 years left. The future value or the par value is $1,000. It's pretty much always $1,000 because that's what they're going to pay you for the bond when it matures. The coupon rate is going to be the rate that they pay you each year for having that bond. So let's say that it's 8%. And then the payment, depending on if it's annual or semi-annual, will be that coupon rate times your par value or the future value. You can set it up that way. So $80 a year. And then
So if that was semi-annually, would it be 0.04 times your par value?
yeah, so you'd want to divide that by 2, and then you would change your number of periods to be double what it is. So 16, because it's doing semi-annual for the whole 8 years.
So always adjust everything according to
So
semi-annually or annually.
Yep, and there will be that difference. So make sure you understand that. So just to review that again, you need to double your number of periods. So if you have 8 years left, but it's semi-annual, you want to change it to 16 periods. And then you want to divide your rate by 2 because again, you're doing the payment twice a year based on the same percentage. It'll be $40 rather than $80. But just to go over it as annual, take that back away. And then your going rate is just going to be whatever the current rate is, whatever the going rate is. So let's say that it goes to 12%. So this bond's present value is $801.29. And so you'd say that you're selling this bond at a discount because it's worth $1,000, but you're selling it for $801 because they're getting a higher interest rate on the bond for the remainder of the period, for the remainder of the life of the bond. So what you want to do here is I've just plugged the formula in for present value. And if you notice here, it will tell you exactly what to put in here. So the first one is the rate, which is my going rate. It's the new rate that's currently happening. Number of periods is at the top. Payment, which is the $80 annually. And then the future value or par value is the $1,000. You don't need to do anything with coupon rate. You just plug in those numbers and Excel tells you that is the current value. And if you know how to put that in, you can just hit equals and do present value, PV. Or you can click on this insert function here and then look for PV. You can search present value and it will bring it right to the top of my list. And I click on it and then it will even pull up this box that tells me. And then I can go rate. So here's my rate right there. Number of periods is 8. The payment amount is $80. And the future value is $1,000. Okay. So it came up as a negative there. And to fix that, I inserted a negative sign right here, if you guys can see that, just to counterbalance that. Just because with time value of money equations and stuff, something has to be negative going in or coming out. But just to show the positive amount, I inserted that negative there. That's how you'll do that. You can just insert the function there using this button right here. So then if the interest rate drops, let's say it goes to 6%, all of a sudden the bond is worth more because they're getting less percentage on the remainder of the life of that bond. So it'll sell for a higher price, and that's called selling at a premium. So that's how you value the present value of the bond. Now, if you're trying to find the yield to maturity, you want to know how much you're going to make on the remaining life of the bond. That's this down here. And again, it's the same kind of stuff. So let me just delete these. So the number of periods remaining, let's say that there's 7 years left. And again, the payment will be determined based on your coupon rate. So I have $1,000 par value bond. And the coupon rate, let's say, is 9%. So my payment then is going to be that coupon rate times the par value, $90. And then if I'm trying to find the yield to maturity, I want to look at what is the present value market price of the bond. So let's say that this bond is worth $1,200 right now. Okay, so I actually want to put this one in as a negative, or it won't solve. If I put it in as a positive, it will confuse the equation and it won't be able to solve. So I need to enter the market price as a negative. And that tells me that the yield to maturity is going to be 5.48%. And again, that's just a function that I inserted using Excel. And you'll just do function and search rate. That's the first one right there. And again, it tells you exactly what to plug in here. Number of periods, the payment amount, present value, which is this number here, and then the future value. And that will give you, let me add a couple of decimal points. That will give you that yield to maturity rate. Now there's one other type of problem that we'll need to look at, and that is if, and real quick, can somebody tell me what a callable bond is? I'll write it right here. Callable bond.
Isn't that where they can call the bond early and you get a different amount?
Yes, that is exactly right. So that means that there's like a clause in the agreement, in the contract for the bond, that says that the bond issuer can recall the bond early for a call premium. So let's say, for example, and this is, again, you'll use this equation here. So you want to know what was your actual yield. What was your actual, what's the term I'm trying to think of? Your, oh my goodness. Let me stop sharing for just a sec so I can check it. let's see, the realized rate of return. That's the word I'm looking for. So it wants to know what is your realized rate of return. Because they might have said, you know, you have a coupon rate of 9%, but what did I actually make? So let's set up a scenario like that. Let's say that they issued you a 20-year bond, but after the first 7 years, or let's say after the first 6 years, they decided that they're going to call the bond for a call premium. So let's say that your rate was 12%, then your number of periods, you're going to put how many years it's been, not how many are remaining, because they're calling the bond. The bond is over. So if it's been a 20-year bond and they are calling it after 7, would I put 7 or 13 here?
7.
7, exactly, because the bond ended up living for 7 years, 7 periods. Now, for the par value, the future value, that's the ending amount, the ending value of the bond. Generally, the bond premium will be 12% of that plus the original value. So this par value is going to be $1,120. So before you go further, you need to correct your payment, because before you were basing it off of par value and the coupon rate. You need to fix it. So it's going to be the par value, excuse me, the coupon rate times 1,000, just because the value of the bond is generally 1,000. And then your present value is going to be negative 1,000. So my coupon rate was 12%. My actual realized rate of return was 13.15%. And that might seem like it's a great deal, but you got to remember that I was supposed to have that bond for 13 more years, in which case I probably would have made more money in the end if I was patient enough and could have that money invested there. So again, just to review, to get the realized rate of return, you're going to use the rate function in Excel, and then you're going to do the number of periods that passed before they called the bond, not what would be remaining. So 7 years in our case. Make sure you correct the payment to be based off of the $1,000 value. And then your par value is going to be whatever they're giving you. So the call premium. So they're giving me $120 plus the value of the bond. That's my call premium. It's $1,120. And then set your market price present value to 1,000. And then you can solve for your rate of return. If you guys want to review this again, you can go over it here. The video, the problem solutions video for chapter 11 goes over each of these problems again, and I think a little bit more extensively. The guy that made those videos understands these concepts better than I do, so he explains them a little bit more clearly, I think. I understand how to solve them, but I think he understands a better basis of why you do those things. So if you're going to review, I would highly recommend watching that video again. It's like a 15-minute video, goes over all of the problems. But all of these ones that you're going to have to see in your test are in that video as well. So any other questions? Anything else we can review? Might be a good idea to do the required rate of return like we talked about. Would you guys like to go over that?
Absolutely.
Yes, please.
Okay. So the equation I showed you guys is right there. And oops, too many things on my bottom screen. Okay. So it's the required rate of return equals your risk-free rate plus, and then in parentheses, the market rate minus the risk-free rate, close parentheses, times beta. So it might give you a few stock options, A, B, C, D is what I put here, and it will tell you the beta for those stocks. Stock A is beta 1, stock B 1.18, C 1.35, and so on. And then it will also give you those other two values, the risk-free rate and the market rate. So let's say that my risk-free rate is 6% and my market rate is, let's say, 12%. So I'm just going to plug in all those numbers into this equation right here, and Excel will do the work for me. If you don't have Excel, this is a really easy one to solve with pen and paper and a calculator if you have one. Just a regular calculator is fine. we're just going to put equals and then follow that equation. So my risk-free rate plus, and then in parentheses, the market rate minus the risk-free rate, close parentheses, and times the beta. And that tells me that for stock A, my required rate of return is 12%. So I want to make at least 12% for it to be worth it for me to invest in this stock option. Now, if you are using Excel, you can add dollar signs on these to fit that formula there. And then you can just click and drag it down for the rest. And on a PC, if you hit F4, it will automatically add dollar signs. On a Mac, I think it's Control-T, but I'm not sure. Or you can just input them manually. But that then tells me this is my required rate of return based on this beta or risk measurement and these parameters for the market, the risk-free rate, the market rate. This is the percentage that I want to make in order for me to want to invest in that stock. So then let me ask you guys, let's say that I'm looking at investing in stock B, and this is my required rate of return, and they tell me that if I invest in it, I'm going to make, let's say that I'm going to make 15% on my investment. Do I want to invest in this stock then?
Yes,
Why?
because you require 13% and it's higher, so you're going to get more than your minimum.
Right. So for me, that's a safe investment. Let's say that I'm going to make 15% on stock B. Is that one worth it for me?
No.
No, for the exact same reason. It's below my required rate of return on that investment. And that's all there is to it right there. So just remember this equation. You can plug it into Excel or solve it with a calculator and a pencil. But that's what you're solving for, is the required rate. And if it's not above my required rate, I don't want to invest in it.
Are we going to have to do the others with like the probability of occurrence and the variance and the deviations and all that?
I don't think there's anything about deviations or probability of occurrence in this test. That definitely is not in the problems. Everything I've gone over so far for the problem is exactly what you can expect from those.
So it was one of our problems. It was
In your
question
homework,
3.
so in your homework, you mean?
On the problem, chapter 10 problems.
I don't think that there is anything about that. Let me pull my book open real quick and look at the problem exactly because I don't know it for sure. So problem number 3. Okay, so for where it asks you to find the expected rate of return and the standard deviation of the portfolio.
Yes.
So you don't have to solve for the standard deviation or expected rate of return on anything on this test for portfolio.
Excellent.
And I will double check that again after this, and if it's wrong, I'll post an announcement about it. But from what I've done, I've looked over it a couple of times, and I don't remember seeing anything about standard deviation on the test for the problems. Any other questions or anything you guys would like us to go over? We've got about 18 minutes left.
Could you do a P&L, just a break-even analysis for both volume and price?
Yeah, sure. I don't know why my bar won't go away. All right. I have a tab on this exact. Just for that. Profit and loss statement. Okay. So let me take these away. So your profit and loss statement is going to look like this. Profit and loss statement. So total revenue. So it might give you, I'll even delete these because I can go through and show you guys everything you need here. So it will give you maybe the price per service. So let's say that I want to charge $25 a service. Let's make this $65 a service. My variable cost is $25 per service. And then my fixed costs are $300,000. So I want to solve for my number of services. How many services do I need to make? So based on your profit and loss, let's say estimated number of services, let's say that I'm expecting 9,500 of this particular service. So my total revenues is simply going to be my price per service times the estimated number of services. My total variable cost will be my variable cost per service times the estimated number of services. And then my contribution margin is simply the revenues minus the total variable costs. And then my fixed costs are 300,000, which I can just take directly from my info here. And then profit or loss is my total contribution margin minus my fixed costs. So my profit is $80,000 given this information here. So if I want to then solve for volume break even, so I'm just going to make $0, I can use under the data tab, what if analysis, and goal seek, and that will find it for me. So I can set this cell to a 0 value by changing the number of services that I want to find, and then hit OK. So that tells me that in order for me to have a $0 profit, I need to have 7,500 services given. And then using the exact same process, we can solve for economic break-even, which accounts for a profit variable. So let's say that I want to make $120,000 off of this by changing this cell. How many services do I need? I need 105,000 of this service or test or whatever it might be. Have a $120,000 profit. Now, if you don't have, or excuse me, let me do this first real quick. Now, if I'm trying to solve for the price, all I need to do is change the cell that I'm editing. So let's say that I know for sure I have a very good educated guess that's based on statistics and what we're expecting in the forecasted quarter or period or whatever period we want to be looking at, and I'm going to have 80,000 of this service. And so I now want to know, not 80,000, 8,000, there we go. I want to know then what price do I need to set. So I want to set this cell to 0 by changing my price per service. Okay. So I need to charge $62.50 if I'm given 8,000 services in order to have a 0. So you just need to change that cell in order, if you're doing volume or price. Now, if you don't have access to Excel, or if you're using the online one, I've been told that the data tab is not on the free online version. So you can use this equation to solve the same thing. So if I'm trying to solve for volume, then I will go total revenues minus total variable costs minus fixed costs equals profit. And my total revenues, as we talked about, is price times volume minus, and then the variable cost times the volume is my total variable costs minus fixed costs is 0. So let's go through this really quick. And let's use some of this other info that I had before. What did I say? 7,500 of these. Let's see. Okay. I guess actually we're trying to solve for volume. So based on this information then, so I'm going to have my total revenues, which is simply my price, which is $65, minus volume, minus, or excuse me, that's going to be times volume there. Sorry about that. Times volume. So 65 times the volume, minus my total variable costs, which can be broken into $25 times the volume, minus my fixed costs, which is $300,000, equals profit. And remember, when we're doing volume break even, we just want to have a $0 profit. So we can set that to 0. So now we just use simple algebra to move these things over. First, we'll add our fixed costs to both sides, which will leave us with $65 times the volume minus $25 times the volume equals $300,000. So now, since I have these two variables the same, I can just add them. So 65 minus 25 is 40. So I have $40 times my volume equals $300,000. Now I just divide both sides by 40 and I should be able to get my break-even volume. So let's see here if I do this correctly. So 300,000 divided by 40 gives me 7,500. That's my break-even volume, and we can plug that into our statement since it's already used and double check. $0, 7,500. Now, if you're trying to solve for a profit variable, all you're gonna do is add that in there. So I want to make $50,000, and then that will change the rest of this equation. So then here I'll have $350,000, and then here I will divide both sides, and so it'll be 350 divided by that 40. And now my volume is $8,750, or 8,750 visits in order to have my $50,000 profit. And let's check if that's correct. Right there. Now, if you're trying to solve for price, some people will get confused. If I'm solving for price, I need to set this up a little bit differently. So my total revenues is my price times my volume. So let's say that I know what my volume is. I'm going to have 6,000 services. So what price then do I need to make this in order to have a $0 balance? So you're going to set it up like this. Price times, and my volume is 6,000, minus, and I know both variables for this. So it's my variable cost times my estimated number of services. So 25 times 6,000 is 150,000. So I can just put that in there directly. 150,000 minus my fixed cost, which is 300,000, equals my profit, which we're going to set at 0. So then when I'm solving, I just need to add both of these sides, both of these numbers over. So if I do that, and I'm going to skip a step here, I'm not going to do it each step individually. But I'm going to have my price times 6,000 equals, and if I add that 150 over and then that 300,000 over, I'm going to have $450,000. And then divide both sides by that 6,000, and then the price that I need to set at this volume is 450,000 divided by 6,000. That gives me $75. And again, we can check it plugging it in here. I know if you don't have Excel, you're not going to be able to do that necessarily. Not using a Goal Seek, you can still create this though on your Excel and then check your answer. So if I set that to $75, you can see here that I have 0 profit. So this equation works both ways. Just make sure you're conscious of which variable you're trying to solve for, whether it's price or volume. And you solve it a little bit differently based on which one you're trying to find. Do you have any questions about that, Connor?
Looks fantastic.
Awesome. All right, we've got about 6.5 minutes left. Do you guys have any more questions for me?
I want you to do a balance sheet and an income statement in 6 minutes.
I'll refer you to pages 85. Just kidding, honestly. It's 85. Oh, and 112. I'm surprised I remember that.
Oh, gosh.
Plus, the open labs for the previous 2 exams are still up as well, so you can watch the first one, and we go over those, I believe, in those open lab videos.
Yeah.
Do we do anything with perpetuity?
You don't. I remember there was a question about it on the previous exam, or on one of the assignments, and it asks you what is the future value of a perpetuity,
Yeah.
and the answer is there is no future value. It's an indefinite thing. It's an infinite. So you can solve for one specific period, but it technically doesn't have a future value. There's no math involved, and I don't remember there being a question about it on the test, but just understand that and you should be fine.
Okay.
And again, I did tell you there is a future value and a present value problem. And again, you can just solve those in Excel or using a calculator.
Yeah, those are easy.
Those are easy things. So, Connor, also I go over the income statement and balance sheet in the other video that I posted last week on Saturday morning, if you want to review those there.
Well, I'm all out of questions. I think it should be. You said on the other video it wasn't as bad as people think it's really going to be. Is that still true?
That was last semester, and I feel like I've said that about a couple of these tests, and then people always tell me it was harder than I thought. I'm not going to make any of those statements this time.
Okay.
So it doesn't focus as heavily on the most recent material, which I think a lot of people expect it to. It does have its fair share of questions about bonds and investments and things, but it does have an equal amount of the previous sections or more, so it's not so heavy on these last 2 chapters. All right, any other questions before we end the meeting here?
I'm okay.
I think that's it.
All right, well, thanks for coming, you guys. I hope you do awesome on the test. We've got till the 27th, I believe, to take it. So
Cool.
do your best.
You're the man, Sam.
All right, see you guys.
Yeah.
Bye.
Good night.